Hello friends, welcome to learning sessions and this is the 40th session for the BFM and we are going to cover the next chapter from the module C that's related to the treasury products. And definitely this chapter is also very much important from the exams point of view, so do confirm the audio video quality at the earliest so that we can proceed. Do confirm the audio video quality, and if you have not subscribed to the channel yet, do subscribe at the earliest and press the bell notification icon so that you get updated whenever we upload the new videos. The complete course is available for the CAIIB in Hindi mix English language as well as in English language, where we'll be providing you the full course videos, chapter wise previous year questions, mock test, case study videos, and the PDF files chapter wise format, right? So you can be getting them all. Just simply download the application from the link iibf.info/app and you will be finding all the details over here. And if you're iOS user, it will be asking you for the ORG code, that is the organization code, which is GEGKD. So the audio video quality is working all fine. So let's start the session at the earliest. So do confirm the audio video quality. Many persons are facing the issue right now. Okay, so it's working fine. So let's start the session. So it is about the chapter number 2 from the module C of the bank financial management about the treasury products. Now, when we are talking about the treasury, there are multiple products into it. Whether we are talking about the derivative or all, those are the different products under the derivatives under the treasury, which are being dealt by with the treasury people, right? So we talked about the different parts of the treasury department, like we are having the front office, middle office, and the back office, right? We have already covered that thing in the previous session, but now it's about the treasury product. The first one, it's about the foreign exchange products, right? So foreign exchange, the products which are being traded in the foreign exchange market, those are the foreign exchange products. Like we do deal in the spot rate, we do deal in the forward rate. Now spot rate is basically like that settlement is on T plus 2 days basis. We have already covered the different rates. Like I have already given you idea related to the rates in the module A. Like the cash rate is on T plus 0 basis, the term rate is on T plus 1 basis, and the spot rate is on T plus 2 days basis. Settlement is there. And in case of forward rate, the settlement is on greater than 2 T plus 2 days. So let's say if we did the transaction today, let's say we did the transaction on the 31st of the July, right? We did the transaction 31st of the July and it's going to mature on 15th of the August, right? In that scenario, what it will be? It's greater than, the settlement is beyond 2 days, right? So it will be the forward rate which will be applicable, and the trades which are being done, those are said to be the forward trades. And forward rate is what? It's a derivative. It's a derivative because it's based upon the underlying price of the spot rate of the particular asset. Clear with it? We have already covered it. The next one, it's about the swaps. Now the swaps are basically the combination. It's a combination of the spot and the forward transaction. So we'll be having the combination of spot or forward transactions, or we'll be having the combination of the two forward transaction, and that is said to be the swap. Let's have a look at the example over here. Let's say it says there is exchange of the cash flows. We are buying the basic USDs with rupees in the spot market and selling the same amount of the USDs in the foreign market, right? So it is basically what? It is a swap. Like you bought the USDs in the spot market, like you'll be getting the USDs after 2 days, but you sold it in the forward market. We bought the USD in the today market price, like we bought it for, let's say, 89.15, and we sold it in the forward market for, let's say, 90.30, right? So that is what, that's a swap contract. That's a swap contract. So it's basically like we are doing simultaneous buying and selling, right? But you must be confusing it with the term arbitrage. See, arbitrage is like simultaneously doing the thing at the same time and will be executing the both the legs on the same time, but it is not the case with the swap. In case of swap, there is a forward leg. There is a forward leg, or there are two forward legs in it. Clear with it? So that's about it. Further, it's about the investment of foreign exchange surpluses. Like if you're having the surplus balances in your Nostro account, you are aware of the Nostro account now. Now, if the bank is having the surplus balance in the Nostro account, the bank can be using those particular funds for investment purposes. for like whatsoever the profit that you are having in the treasury operations, whatsoever the profit that you gain from the branch operations or your overseas markets or something. Now these surpluses can be invested into the different avenues, right? You can be like investing, you can be giving the interbank loans out of these surpluses. Now whatsoever the surpluses you will be having, you can be giving the interbank loan, right? It can be one of the case, or it could be like you can be doing the short term investment in the bank. You can be doing the short term investment, or you can be doing what, that you can be having the auto sweep facility, like where the like we are having the auto sweep facility in our saving fund accounts and the current accounts. In the same way, we can be having this kind of facility in the nostro accounts, where the surplus balances will be invested itself, right? So that is the scenario. So let's have a look at in detail that what are the different avenues which are available. And also these surplus balances can be related to idle balances in the EFC account or the RFC accounts. Like the surplus foreign currency we are talking about, right? So let's say if you're having surplus foreign currency with you, you can be investing into different avenues. And what are those avenues? The first one, it's about the interbank loans, right? So we are to discuss the different avenues first of all. Like first one, it's about the interbank loan. Like these kind of loans can be given, like you can be lending between the bank itself. Now in case of the banks, when we are lending in between the banks only, is there credit risk? A very low credit risk is present. Now, when we are dealing with the borrowers, definitely a credit risk is available, right? But in case when we are going for the interbank loans, in that scenario, the credit risk is very much low. So it's like placement of the surplus foreign currency funds with the other banks, and that's basically commonly done for the overnight basis. But the maximum tenure can be of 1 year. Let me highlight that particular part for you. So the common is basically for 1 day for overnight basis, but not exceeding 1 year term, right? And you can be lending for to the domestic banks, you can be lending to the international banks, and definitely it must be within the pre-approved credit limits. Now you may be having the pre-approved credit limit with some bank, and you can be availing such facility from that particular bank up to that particular level. So that's the case with it. That's the case with it. Clear with it? And also such surplus balances, such surplus balances can be used for the short-term overseas investment purposes. Like it can be used for investment into the treasury bills which are issued by the foreign governments. Like you can be investing the money there, right? Or it could be the case that you can be investing into gilts, or let's say sovereign bonds. Like let's say the sovereign bonds which are issued by the foreign government, right? Which are very much safer. Or you can be also be investing into commercial papers. Now commercial papers are somewhat on the riskier side. These are somewhat on riskier side, but when we're talking about these treasury bills or gilts which are issued by the government, foreign governments, these are very much safer. These are very much safer. These are on the safer side, right? And you can also be investing into triple A rated bond or something, or let's say whatsoever is approved by your bank board, you can be investing your money there. And or let's say which is allowed by the regulator, you can be investing your amount there. Further, it's about the Nostro accounts. Now, what is the Nostro account? Basically, the Nostro account is like a foreign currency account which is maintained by your bank with a foreign bank, right? It's a foreign currency account, but outside India it is being maintained. That's basically what it's a Nostro account, right? And we need to manage this Nostro account. How to keep manage this Nostro account? Because no interest is being paid on these Nostro balances. Let's say even if having USD 1 there, or let's say when you are having 1 million USD over there placed in the Nostro account, you won't be getting a single penny of interest rate over there. So the funds, but the funds are to be maintained by the banks. The banks are to maintain the funds. Those are to be maintained for the customer payment purposes. Those are to be maintained for the trade settlement purposes, right? So in those Nostro accounts, we can be going for the automatic investment facility. It's already written over here. So we can be going for the automatic investment facility in those accounts. Let's say we basically set a threshold of 1 lakh USD. Now whatsoever the balance beyond 1 lakh USD, that will be invested into different markets. right? So whatsoever the excess funds which will be identified by the bank at the end of the day, those will be automatically be invested into the money market for the overnight basis, or it can also be invested into the other sectors, right? And the whatsoever the interest you will be earning, that will be credited to you the very next day. So it's just like you are converting your idle balances into the interest earning assets. So definitely your efficiency is increased. The next one, it's about the loans and advances. Definitely for the forex deployment purposes that can be done. For which purposes? For the forex deployment purposes. Now what does it mean? It means now there is no credit appraisal. No credit appraisal which is performed by the treasury. Treasury does not do that. But the treasury do provides the foreign funds. Foreign currency funds are being provided by the treasury only. Let's say even if the credit department is to sanction a loan in foreign currency amounting 10,000 USD even, or let's say even 100 USD only even. Further, first of all, the department is to take a permission from the treasury that from where the funds would be available, and then only the amount can be disbursed, right? So what will be managed by the treasury, because treasury is not involved in the credit appraisal or credit disbursement. So clearance from the treasury is required, like for the availability of the foreign currency funds and the cost of funds. The clearance is basically required prior to sanction of the foreign currency advances. That's it. That is basically required. So whether it is about the FCNR loan, we are talking about foreign currency non-resident loan, you are having the FCNR balances with you, and against those balances, the loan is to be taken, or it is a pre-shipment facility or the post-shipment facility, or even the bill discounting is to be done, Those activities are being performed by the treasury. Then after that, it's about the rediscounting of the foreign bills. Now, what is rediscounting? Discounting is a simple process. Let's say the exporter is here. Exporter basically gave the bill to the bank, and bank discounted that particular bill and provided the liquidity to the exporter. Now, this bill is available now with the bank. This bill is now available with the bank, but bank requires also the liquidity. Now, the bank will be getting the refinance from the, let's say, some other bank for the interbank exposure, or let's say it basically discounted the bill with the Exim Bank. With the Exim Bank, this is basically discounted. Now it's basically rediscounted because now it's not a bank to borrower exposure, it's an interbank exposure. Now when the rediscounting is being done, it's an interbank exposure. And for what particular purpose the bank is to maintain much more capital? For the borrower exposure or for the interbank exposure? Just do answer at the earliest. If the bank is lending to the borrower, if the bank is lending to the borrower, then the bank is to allocate more capital, or when the bank is basically getting the funds from the Exim Bank, then the bank is to allocate more capital. Definitely, in the case of the interbank exposure, when the bank is dealing with the bank, or we can say when the rediscounting is being done, in that scenario, the lesser capital is to be allocated. That's the first benefit that will be available. So it's a simple process. Simple process of what? Like the treasury provides a funding to another bank by rediscounting the foreign bills. Because I just stated the Exim Bank over here, but it is not always the case. Let's say the bank A over here, first of all, discounted the bill. Bank A discounted the bill. And now the rediscounting is being done by the bank B. Bank B is rediscounting the bill with the bank A. That is what? That is the rediscounting. Now the exposure would be what? The exposure would be the interbank exposure. That's a very important point for the conceptual clarity purposes. Interbank exposure it is, right? And it is on with recourse basis. This is always and always on. The rediscounting is done on recourse basis. With recourse basis, what does it mean? It means if the default is being done by the exporter with the original bank who has discounted the bill, then the responsibility will be with the original bank only. That's a with recourse, that the bank B can be recovering the amount from the bank A, right? And further, the tenor for such rediscounting of the foreign bills, it is minimum 15 days. The minimum tenor is of 15 days and the maximum tenor is of 360 days, right? Clear with it? So lower credit risk is there, but what are the benefits? What are the benefits of this? First one, it was related to the lower credit risk because the interbank exposure is there. So lower credit risk is there. And also this is related to short-term deployment of the funds. For the short-term basis, you can be deploying your funds. Is that clear? Now, after that, it's about the money market products. The next topic that we are going to cover about is about the money market products. Again, a very important topic. Now, what do you mean by the money market products? What do you mean by the money market products? When you're investing the amount for the short-term duration, right? That's a money market, like for short-term basis, like lesser than or equal to 1 year maximum, really not greater than that. So when we say the investment, or let's say the borrowing in the market is particularly is maximum up to 1 year, that's basically a money market product. First of all, it's about the interbank market. Very important topic. The interbank market. Now, what do you mean by interbank market? Interbank market where the banks are lending to each other. Now, that particular lending goes from day 1 to day 365. Like from 1 day to 365 days or up to 1 year, right? So when we are lending or let's say borrowing for up to 1 year for overnight basis, we say it to be the call money. When we are doing it for overnight basis, like for 1 day only, it is said to be the call money. It is said to be the call money. And when it is being done for let's say from 2 days to 14 days, from 2 days to 14 days, we say this to be the notice money, right? And when we say it is from 15 days, that is exceeding 14 days or up to 1 year, then we say it to be the term money. Clear with that? And basically, it reflects what? It reflects the banking system liquidity. And what is the benchmark rate which is used for the interbank money market? That's basically the MIBOR. That is Mumbai Interbank Offer Rate. This is basically used as a benchmark rate. This is the benchmark rate that is being used. Clear with it? After that, the next product from the money market where the treasury deals is a treasury bill itself. Now, the treasury bills are basically issued by the government of India, but these are issued through the Reserve Bank of India. And these are available for different tenors, like for 91 days, 182 days, 364 days. And this is predetermined, right? And this is a zero coupon security. Like what actually happens when you invest into bond, let's say you invested amount of rupees 1 lakh into the bond, you'll be getting an interest rate, which we say to be coupon. You'll be getting the coupon after every particular periodic tenure. But that is not the case with the treasury bills. In the treasury bill, let's say if the amount is 5 lakh rupees for which the treasury bill is issued, the minimum amount, let's assume, right? In that scenario, it won't be issued at rupees 5 lakh because 5 lakh is a face value. It won't be issued at the 5 lakh, but it will be issued at a discount to the face value. It is issued at a discount to the face value. Now, what does that means? Discount to the face value means that you will be getting at a lower price than the face value. Let's say we got it for rupees 4.5 lakh. We got it for 4.5 lakh, and at the maturity, let's say we invested into 91 days treasury bill. So at the maturity after 91 days, we'll be getting 5 lakh rupees only. That's basically what that's the treasury bills. So treasury bills are the zero coupon securities. These are issued at discount and it is said to be the implicit yield. We say this to be the implicit yield. Okay. And it is held in dematerialized format and auction based pricing is being there. And these are being held in the SGL account, subsidiary general ledger account. So if you have to hold it, you must be maintaining a SGL account with the Reserve Bank of India and it is in dematerialized format and it is very risk free. It is very much liquid in the secondary market and further it's basically works as the treasury bills work as the benchmark for the debt market yield. It works as a benchmark. Many times the treasury bill is basically taken as a benchmark. Clear with it? Right? And what is the denomination? What is the denomination of the treasury bills? Anyone? Do answer at the earliest, because these are the commonly asked questions. So, what is the denomination? It is 25,000 rupees. For the treasury bills, the minimum denomination is 25,000 rupees, and further multiples thereof like 50,000, 75,000, and so on. Getting it? So, it is about the treasury bills. The next topic that we're going to cover, it's very much important. Again, it's about the commercial papers. Commercial papers are unsecured money market instruments. These are what? These are the money market instruments, and these are unsecured. Now, in case of the treasury bills, those were issued by the government of India through the Reserve Bank of India. So those were very much secured. But the commercial papers are very much unsecured. These are unsecured money market instruments which are issued in the form of the promissory note. These are issued in the form of the promissory note, and these are regulated by the Reserve Bank of India, and further the market practices are set by the FIMDA. So regulated by the Reserve Bank of India, and further what sort of the market practices are there? Those are given by FIMDA. What is FIMDA? It is Fixed Income Money Market and Derivatives Association of India. Fixed Income Money Market and Derivative Association of India. Clear with it? And what is the minimum denomination? Why I'm saying it to be promissory note? Why I'm saying it to be promissory note? You should not be just cramming it. You should be knowing the basics of it, right? So let's say company XYZ want to get the working capital. Now working capital is basically for short-term duration, and the commercial papers are also for the short-term duration. The minimum tenure for which the commercial paper is issued is for 7 days, and maximum for the 12 months. The commercial papers can be issued. Minimum 7 days, maximum 12 months, right? So XYZ wanted to raise the capital for the working capital purposes, and for that particular purpose, they issued the commercial paper. And let's say they issued the commercial paper amounting rupees 100 crore, right? Now, what will be happening? What will be the case? Now, first of all, if you want to issue the capital in the form of the commercial papers, you have to get a credit rating, and that credit rating will be issued by the credit rating agency. So we are having the credit rating agency, let's say CRISIL, ICRA, or Samira, or anything, S&P or something, right? The credit rating agency will be issuing the credit rating, and the minimum credit rating which is required in case of the commercial papers, it is A3. A3 is a grade, right? For the short-term purposes. And this is a minimum credit rating which is required. Let's say the credit rating A3 or the better one was issued by the credit rating agency. And further, the company issued the particular 100 crore rupees commercial papers to the public, to the investors. Now, the investors won't be getting the coupon, because as such, if we match it with the treasury bills, these are also issued on discount. But in this case, these are not guaranteed by the government of India. These are issued by a company, and companies just promising. Companies doing what? Companies just promising that we will be paying you back your money. The face value which is mentioned on the commercial paper itself will be paying you back this much amount. So that's why I am saying that the commercial papers are the unsecured money market instruments which are issued in the form of the promissory note. Minimum maturity 7 days, maximum maturity 12 months, issued at a discount. The denomination is of 5 lakh rupees and multiple thereof. Clear with it? And who can be issuing these commercial papers? The companies can be issuing, NBFCs can be issuing, all India financial institutions can be issuing, and also all the other entities which are having the net worth greater than 100 crore. So if your net worth is greater than 100 crore rupees, even if you are LLP, you are, let's say, an LLP, a firm, or let's say anything, you can be issuing the commercial papers. But the requirement is net worth should be greater than or equal to 100 crore. Other than that, where the net worth does not matter, if you're NBFC, your All India Financial Institution, your company, you can be issuing the commercial paper. And also, all your assets must be the standard assets. It's not the case that your loans are substandard or non-performing asset. So all the asset must be the standard asset, and you must be having a working capital facility with you, which must also be the standard, right? These are the requirements. These are the requirements. And what is the minimum rating which is required? It is A3. The minimum rating, the minimum credit rating I can say, which is required is A3. And if you are to issue the commercial papers greater than 1000 crores, let's say if you want to issue the commercial papers and the total issue size is exceeding 1000 crores, then the credit rating from the two credit rating agencies is required. So if CP amount is basically greater than 1000 crore, then the credit rating agency from two, then the credit rating, not credit rating agency, then credit rating from two CRAs is required, and the minimum value will be considered. The lower value will be considered. Clear with it? Okay. Just let me tell you one thing another than that, that the if we're talking about the secondary market, in case of the commercial papers, if we are talking about the secondary market, does it exist? Yes, it exists. And if there is any over the counter trade, over the counter means a bilateral trade between two persons. So it is to be reported to the particular, let's say, platform that we say to be FMTR. We say to be FMTR, that is financial market trade reporting platform, right? Trade reporting and confirmation platform, that is to be reported over there within a time span of 15 minutes if there is any OTC contract, right? And is loan is permitted against the CP? No, no loan is permitted, no loan is allowed against the CP. No loan can be taken. And buyback is allowed. Yes, the company can be buying it back after a period of 30 days. And if the CP is going to be mature on the holiday, let's say CP is maturing on 15th of August and it's a holiday, right? So it is to be paid on the previous working day in that scenario. Then it is to be paid in the previous working day. Clear with it? Do confirm at the earliest that if you have understood the point so far, so that we can move ahead with the next topic of the certificate of deposit. So the next money market instrument that we are going to learn about, it's the certificate of deposit. It's also a money market instrument. It's a certificate of deposit. Now, certificate of deposit is what? It is a short-term negotiable instrument and it is issued by the bank. It is issued by the bank. Kindly take a note of it. Why it is issued? Because we want to raise the funds from the public, right? We want to raise the funds from the secondary market. That's the main thing, right? So in the secondary money market, the banks are there, the investors are there. We want to basically seek funds from there. So all the scheduled commercial bank, except the case of the regional rural banks, local area banks, they can be issuing the certificate of deposits. All selected Indian financial institutions can be issuing the certificate of deposit. And if these are issued by the banks, let's say if the certificate of deposits are issued by the banks, in that scenario, the minimum maturity is of 7 days and the maximum is of 12 months. But if it is issued by the All India Financial Institutions, AIFIs, in that scenario, the minimum maturity is of 7 days, but the maximum maturities can be going up to 3 years in case if these are being issued by the All India Financial Institutions I'm talking about. And what is the denomination? Like we discussed in the case of commercial paper, the denomination is 5 lakh rupees and thereafter. The denomination is 5 lakh rupees and thereafter. And these are also issued on discount. So these are issued at discount. These are freely transferable. No loan is allowed. No buyback is allowed. Like in the case of the commercial paper, the buyback was allowed in after 30 days. But in case of certificate of deposit, the buyback is not allowed. The buyback is not allowed. Clear with it? So that's about the certificate of deposits. The next topic that we are going to cover, it's about the repo. It's about the repo. And what is repo? It is said to be the repurchase agreement. It is a repurchase agreement, right? Like what does it indicates? It's just simply like the sale of securities with an agreement so as to repurchase it later. Let's say there are two banks, A and B, and A is selling the securities, right? A is selling the securities, but with an agreement that it will be purchasing it back on a fixed date at a fixed price. Let's say there was agreement that it will be buying it back after 15 days at a particular price, right? So definitely the securities are involved. So it is a secured lending or unsecured lending. It's a secured lending. The bank B is having the secured lending, and moreover, it's an interbank exposure. So in case of the repo, it's like we are going to repurchase, we are going to sell the securities, but with the repurchase agreement in it. That's why it is said to be the repo. And also it's a part of the liquidity adjustment facility. Now, if the same thing is being done between a bank and the Reserve Bank of India, it is a part of the LAF, that is a liquidity adjustment facility. And the tenor for such repo can be ranging from the minimum tenor is of 1 day, and the maximum tenor in case of repo it is 1 year. It is 1 year, the maximum tenor. And who can be participating into it? The banks, financial institutions, primary dealers, mutual funds, corporates, those can be participating into it. And the underlying securities, these securities are the government securities, not other securities. These are the government securities. Clear with it? Let's have a look at it. So repo is basically used for the lending and the borrowing purposes in the money market, where it ranges from 1 day to 1 year. It's commitment to repurchase because there is a repurchase agreement, and only government securities are being used as a underlying security. And further, let's say if you're having the surplus of the securities, you can be having, let's say, place your securities with the other banks, and further you can be having the liquidity with you. And in case if you're having surplus liquidity with you, you can be lending for the securities basis and can be earning extra money upon it. Clear with it? And if we talk about the interest rate, if we talk about this particular point, that's the interest rate. The repo rate slightly is lower than the unsecured money market rates. It's slightly lower, right? Why it is lower? Because it's a secure transaction. And it's not the case that if you're placing 100 crores of the security, you'll be getting 100 crore rupees of the loan. No, there is a margin which is applicable. There is a margin which is applicable. Like let's say the margin is of 5% value which is applicable. Now for the 100 crore rupees of the securities, you'll be issued 95 crore rupees of the loan amount. And the settlement for this repo transaction is being done through the CCIL. The settlement is all being done through the CCIL, that is Clearing Corporation of India Limited. Clear with it? Do confirm at the earliest that if you have understood these particular points or not. And there is repo facility which is available under the liquidity adjustment facility. I just told you about this. There is a repo facility which is available under the liquidity adjustment facility, right? Now the repo is being used by the Reserve Bank of India extensively for the monetary policy purposes. So what is the main objective by the Reserve Bank of India? They want to control the liquidity in the banking system. They want to control the liquidity in the banking system. So let's just consider the case. So if the liquidity shortage is there, what we're talking about, if the liquidity shortage is there, then RBI will be doing what? RBI is to put more money into the system. So RBI is going to lend funds. RBI is to lend funds in that case when there is shortage in the market, shortage of liquidity in the market. And what tool is to be used? The repo rate will be used. The instrument which will be used, the repo instrument will be used. So RBI will be lending. RBI will be lending, right? And further liquidity is infused. On the other hand, let's say if there is surplus liquidity in the market, Then the RBI is going to use the tool which is said to be the reverse repo. So RBI will be asking the banks so as to place their surplus funds to be placed with the Reserve Bank of India, right? So in that scenario, RBI is to absorb the funds. So RBI is going to absorb the funds in that case. Clear with it? Do confirm at the earliest. So why it is used? It is used to stabilize the short-term interest rates. It is used to manage the inflation. It is used to manage the liquidity. Clear? So RBI uses the repo and reverse repo intensively under the monetary policy. The next topic that we are going to cover, it's about the CBLO. It's about the CBLO. What is CBLO? It is collateralized borrowing and the lending obligation. Collateralized borrowing and the lending obligation. That's the CBLO. Right? So what's the main concept related to it? So these are the money market instruments which are introduced by whom? Which are introduced by the CCIL itself. The Clearing Corporation of India Limited has introduced it. Right? These are launched by the CCIL itself. Right? And further, CBLO is essentially a repo instrument. CBLO is what? CBLO is a repo instrument which is used not only by the banks but also by the primary dealers. Like you can be having a through the, let me just tell you that let's say we are having the CCIL over here, and let's say if we are having the surplus funds, the persons on the left side are having the surplus funds or liquidity. The persons on the right side are having the surplus of the securities, right? So the surplus securities are to be placed with the CCIL, the surplus funds are to be placed with the CCIL, and CCIL will be matching the CCIL will be matching what? CCIL will be matching the or will be doing the order matching. CCIL will be doing the order matching, and for the person who require the funds, they'll be getting the funds. The person who requires the securities or want to earn the interest, they will be earning the interest. And further, the complete transaction is managed by the CCIL, Clearing Corporation of India Limited. Now, when the transaction is being managed by the intermediary, the counterparty risk is gone. That's about the CBLO. That is about the CBLO. And the term for it can be ranging from 1 day to 1 year. It can be ranging from 1 day to 1 year. And further, CCIL is going to act as an intermediary. No, intermediary it is acting as, so there is no counterparty risk. Previously, if the bank A is dealing with the primary dealer, right? Let's say definitely there is a counterparty risk which is existing, but not anymore because the CCIL is a party to it, is an intermediary to it, right? And it is also actively traded in the secondary market, right? But now the CBLO is gone. It's not anymore used in the market. And instead we are having the TREPS. What we are dealing with? We are dealing with the TREPS, that is tri-party repo. It is the tri-party repo, right? So tri-party repo is facilitated by whom? It is facilitated by the CCIL. It is basically facilitated by the CCIL. So CCIL is going to act as the manager. It is going to act as a collateral manager. And on the other side, the CCIL is going to act as a settlement guarantor. Or we can simply say it is going to act as a guarantor. So banks, mutual funds, NBFCs, corporates, those can be investing into the TREPS. Those can be those can be participating into TREPS, and there is no counterparty risk. There is efficient collateral management, and that is very much high liquidity is there. Clear with it? After that, it's about the bill rediscounting. The next topic that we are going to cover, it's about the bill rediscounting. Now, what is bill rediscounting? The treasury is going to rediscount the bill that has already been discounted by the bank. We have already covered this topic in a way, like if the bank A has discounted the exporter's bill, now the bank A forwarded this discounted bill to the bank B, and the bank B is going to discount this bill again. That's basically the bill rediscounting. And it typically ranges from 3 months to 6 months. Typically, the bill rediscounting ranges from 3 months to 6 months. Why bank B is eager to rediscount the bill? Because low risk is present. Why low risk? Because it is with recourse with the bank. This rediscounting is with recourse with the bank. Low risk is there, and bank B can be earning, right? And why the bank A want to rediscount it? Because previously it was a borrower exposure, but not anymore. Now it will be an interbank exposure. Now it will basically, this transaction is going to improve the capital adequacy ratio for the bank A, right? Clear with it? So that's about the bill rediscounting. So it's going to improve the capital adequacy ratio for the borrowing bank. The next one, it's about the securities market products. It's about the securities market product. The first one, it's about the government securities. Now, the treasury primarily do invest into the government securities. Why? First of all, we want to invest the money, surplus money, so that we can earn interest. And moreover, there is a requirement, which is statutory requirement, which is imposed, that is related to SLR, statutory liquidity ratio. We have to maintain the SLR, right? Otherwise, the penal consequences will be there. So that can be fulfilled if we do invest into the government securities. And the SLR can go up to 40%. The maximum SLR can be go up to 40%. Right now it's around 18%, right? But it changes from time to time. And these government securities are issued by the government of India. These are very much liquid, and further these are very much secured, right? And further these are issued through the Reserve Bank of India, PDO. So RBI's PDO, Public Debt Office, do issue the government securities. And the tenor for these securities can be ranging from 1 year to 30 years. The tenor for these government securities can be ranging from 1 year to 30 years. That's why we say these securities to be dated securities, because these are for very long term also, right? And the RBI also uses, the RBI basically issues through the OMO also, through the auctions also, through the OMO also. Through the auction, like when the auction will be done, and further these will be issued at discount, right? And the other one, it would be related to the OMO for the open market operation purposes. This is known as the open market operation purposes. So when the RBI wants to absorb the liquidity, the RBI will be selling the securities. And when RBI want to inject the liquidity, RBI will be buying the securities. Now, when the RBI will be buying the security, let's say the securities were already issued and RBI buy back the securities. Now the new money supply will be there in the market. Clear with it? So that is said to be the open market operations. When the outcry sale and purchase is being done openly in the market, that's the open market operations, right? And there is an obligation that the banks are to invest in the government securities, but not only for the SLR purposes, but also if you want to earn the profit from these securities, right? And tenor, I have already told you, it's basically ranging from 1 year to 30 years. After that, it's about the corporate debt paper. Corporate debt paper. Now, these securities are being issued by the corporate. So, these will be secured enough? No, these are not secured. These are not that much secured. These are the debt papers. These are the debt papers, and these are for medium term and the long term period. And these are also known as the non SLR securities, because these do not fulfill the criteria for the statutory liquidity ratio purposes, like bonds, debentures, tier 2 capital bonds are there, right? And definitely Unsecured or lesser secured means more return as compared to the government bonds or government securities. And the risk varies from the credit rating to credit rating purposes. As I told you that when the commercial papers are to be issued by the corporates, like the same case is applied over here when the debt instruments are to be issued by the corporates, right? In that scenario, the credit rating is to be taken care of. The credit rating is to be taken, it is to be issued, right? And further, based on the credit rating, we can be having the perception that what risk will be available over there. And these are issued in the demat format. These are basically issued in the demat format. Kindly please take a note. These are issued in the demat format and these are actively traded in the secondary market, right? And there is a simple concept: lower the risk, lower the return. And when we say higher risk is there, then you are also perceiving the higher return. So lower risk, lower return, higher risk, higher return is there. Clear with it? Clear with it so far? Do confirm. Then the next one, it's about the debentures and the bonds. So just take an idea. When I'm talking about the debentures, these are issued by the private corporates. By the private corporates, the debentures are issued. And when we're talking about the bonds, these are issued by the public sector institutions. These are issued by the public sector institutions, right? And the debentures do come under the company law. These do come under the company law. Whereas when we're talking about the bonds, those do come under the contract law. Those form a contract. So those come under the contract law. And the bonds are negotiable. There is transferability of the bonds and these are negotiable. But in the case of the debentures, these are transferable by registration. The registration is required. Then only you can be transferring it. Clear with it? So both are the debt instruments. Both acknowledges the debt instruments and the debentures are basically issued by the corporate bodies, like by the private corporates, and the bonds are issued by public sectors, right? So conventionally, we can say debt instruments, which are debentures are the debt instruments which are issued by the corporates in the private sector, while bonds are issued by the institution in the public sector, right? Clear with it? Now we are having the multiple type of debentures, like we have the convertible debentures. Now, what do you mean by convertible debentures? Convertible debentures are those debentures which can be converted into equity. Like we are having the debenture and one debenture would be converted into 5 shares or 5 equity shares. Now it's your will if you want to convert them into the equity or not. So if it is favorable to you, let's say I purchased one debenture for 10,000 rupees, right? And it gave me options that I can be converting into this debenture into 5 shares after some fixed tenure, right? And at that particular time, the company share was trading at 2,600 rupees. Now, definitely, if I'll be converting my debenture into the equity, I'll be getting 5 shares, and each share is valuing 2,600 rupees. So definitely the value is way more than 10,000 rupees. So definitely it's favorable. I'll be going for that, right? So it's like a benefit. And what would be the benefit for the company? Like if I'll be converting the debenture into equity, what will be the benefit to the company? Just take a note of it. Debt for company, the debt is to be repaid, but not the equity. The equity is not to be repaid because equity showcases the ownership and it is not to be paid by the company back. But debt is a liability on the company which is to be repaid by the company at any time. Okay. So that's about it. And the debentures could be secured, it could be unsecured debentures, and also the charges may be created upon the bonds. Like bonds may be secured by the mortgage, or charge may be created, a fixed charge may be created, or a floating charge may be created, or let's say even a unsecured bond may be issued, right? Is that clear? And also sometimes a trustee is basically appointed. The issuer appoints a trustee sometimes. That's there is a threshold related to it, but sometimes it's an obligation that you have to appoint a trustee. Now, what's a trustee's role? What is a trustee's role? So trustee's basically role is to protect the investor. Its role is to protect the investor, so it acts in the fiduciary capacity. Clear? Clear with it so far? Do confirm at the earliest. So for the convertible bonds, I've already told you these are mix of the debt and the equity. Debt and the equity, mix of it. So you are previously having a debt instrument which you can be converting into equity after some particular tenure. So definitely if the issuer company's price is higher than the prefix conversion price, it's beneficial, it's favorable. You will be converting your debt into equity. And what is the benefit to the company? There is no debt repayment. Like I told you, there is no debt repayment because the equity is not to be paid back, right? And further, the coupon on convertible bond is generally lower. Coupon is the interest rate which is being earned by the investor. Now, in case of the convertible bonds, the coupon is comparatively lower side. Clear with it so far? Do confirm at the earliest. If you have understood this particular concept, do confirm at the earliest. The next topic that we are going to learn about, it's related to the equities, where the treasuries can be investing. Now the treasuries can be investing into equities also, but that must be permitted by the board of directors. And also in the listed equities, you can be investing the money into. And it's basically subject to the capital market exposure limits, which are set by the Reserve Bank of India. Now let's say if the Reserve Bank of India says that you cannot be having the total capital market exposure, direct or indirect exposure, more than 40% of the tier 1 capital. So you cannot be breaching that particular thing, right? So that's about the threshold which is fixed by the Reserve Bank of India. And equities are traded in the stock exchange and stock prices are very much volatile. So it's a very, 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 important decision to be taken. So you have to check the company fundamentals. You have to go for the macroeconomic factors. When I'm talking about the fundamental factors or the company fundamentals, I'm talking about the leverage, growth, profitability of the company. And when we are talking about the macroeconomic factors, the treasury is to look into the interest rates, GDP, inflation, etc., or also to check the market sentiment. So when we're talking about the equities, these are carrying very much higher risk. So we can say very high risk. Why? Because the prices are very volatile. So there is market risk and also the price risk, because there is movement of the prices. So the market risk is definitely present over there. So that's why the treasury is having a very conservative approach related to the capital market investments. So they do prefer the government securities. They do prefer the other money market instruments than these particular, let's say, equities. So these are very much volatile, right? After that, it's about the domestic and the global markets. It's about the domestic market and the global market. The first one, it's about the FI investment. That is a FI investment is means foreign investments, and it is FDI and it is FII. FII, foreign institutional investors, and also the FDI, that is a foreign direct investments. Now, when we're talking about the FDI, or let's say when we are bifurcating the FI, we say we are having the FDI, which is for longer duration, and the FPI, that is foreign portfolio investment, it is for short term duration. So FDI is for long term duration and FPI is for the short term duration purposes, right? And basically previously it was FPI, but now it is the FII. We say to be FII, that is foreign institutional investor. Clear with it? Further, now it's the FII, that is a foreign institutional investors. It's a foreign institutional investors like the investment banks, the hedge funds, like they are investing mainly into portfolio investment. So they're having a long-term view, right? And they're making direct investment into the new projects, into the company itself, into the capital investment, rather than on the stock markets, right? Then it's about the ADR, GDR issued by the Indian companies. ADR, GDR issues by the Indian companies. Now, what is ADR? ADR is American Depository Receipt. GDR is Global Depository Receipt. Let's say if the Indian company wants that they want to raise the funds in US dollars, they will be issuing the ADR. So the process is quite simple. Here is the Indian company, right? They will be keeping their shares with the custodian here in India, and custodian will be acknowledging the depository there in foreign country, America, let's say. And based upon that, the ADRs will be issued. ADR is somewhat equivalent to a bundle of the underlying Indian company shares, right? People will be investing the money into it, and ultimately they are investing into the Indian company, and the company will be getting the foreign inflows. Same way the GDR works, but that's for the global market, not only for America. The ADRs are basically, let's say, traded in America, but the GDRs are traded globally, right? And further, it's about the ECB. ECB is external commercial borrowing. We have already covered a complete chapter about it already. You can get the details over there. And other than that, we have the special facilities to the exporters. Special facilities which are basically available to the exporters, that they are permitted that they can be keeping their foreign earnings in the foreign currency only, in the designated EFC account, right? So banks are basically allowed so as to extend the pre-shipment finance, post-shipment finance to the exporters, and that can be extended in Indian rupee and also can be extended in in the foreign currency. The last one, but not the least one, it's about the ODI. That's about the overseas direct investment. So Indian corporates, let's say here we are having a corporate that is basically allowed that they can be investing into joint ventures outside India, or in the wholly owned subsidiary, even WS we say to be wholly owned subsidiary. You can be investing outside India, right? And from where you can be funding the particular investments from the domestic resources. And there is a limitation related. And what is the limitation for the corporate so as to invest outside India? It's basically investment up to 400% of the net worth. So whatsoever your net worth is there, the 400% of it through the automatic route is allowed, that you can be investing outside India. What is the purpose? Why it is there? Because we want the global expansion. It's basically a market access which is allowed. Sometimes you want to acquire the technology from outside India. So that's why it's allowed. Clear with it? That's about the ODI, and that's all about the chapter number 2. I hope that you must have been clear with all the concepts so far. So if you really like this video, do give this video a like, and also do share this video with your friends and colleagues who are preparing for the CAIIB exams. You just simply need to write CAIIB. So as to get the PDF of this session, simply just WhatsApp CAIIB to the number 83609 44207, and I'll be sharing all the details with you, right? So that will be all. Thank you so much, and see you again in the next video.